Okay, good afternoon. I'm Brett Otterman, one of the accountants at Quantum Advisory. And for those of you that don't know, we're an accounting firm that specialises in family businesses. And our mission is to help them step up, scale up and sell up. So with me today is Steve Curtin. He's a senior accountant here and he's going to be taking us through the content.
Hi everybody.
So I'm sure you'll be in very good hands. Now, before we get started, just want to throw in our usual disclaimer that the information in this webinar is general in nature, educational and no substitute for tailored advice specific to your circumstances. Now, today we're talking about building a better balance sheet. Now, that can initially seem, quite daunting and complex, but bear with us, as you'll get a clearer idea on the power and opportunity that lies, within analysing that and optimising it. So a quick agenda of what we're going to run through. So we'll talk about the balance sheet and the story that it tells us about our business and discuss some practical and proven strategies for a stronger balance sheet and the ways to optimise that. We're also going to spend some time on the 4 most important areas of focus, ways to maximise the business value, and then some best practice tips, next steps, and then how we can help. Of course, followed by some Q&A. So get your questions in at any time. Just type them in the Q&A chat box and we'll get to them at the end. So over to you, Steve.
Thanks, Brent. So, looking at the balance sheet today. So often we see business owners and consultants focusing all their energy on the profit and loss statement. So looking at ways to drive up revenue and drive down costs. And while this is important, unless there's a focus on the balance sheet, profitable businesses can and do go broke. So for example, if you drive up sales, but you don't have a great system for invoicing your clients or collecting the money owed, the business can run out of cash. So likewise, a growing business may overinvest in stock and then in a downturn, find it difficult to move this stock and convert it into cash. So cash is often described as the oxygen for the business. So there are many ways to increase cash flow, which we'll cover shortly. So the balance sheet is where your cash is measured. So there are some useful calculations that can be done to show how much cash can be created by influencing other numbers on the balance sheet, such as debtors, stock, and work in progress. So just as your banker will look at your balance sheet to see if your business is solvent, so should you. So trading while insolvent is not only extremely stressful, it's also illegal, and you'll find it very difficult to pay your bills. And it also potentially puts your personally at risk with creditors, the ATO and finances. So we'll show you how to test at a glance if your business is solvent. In a downturn, it's important to make sure that you're not drawing too much out of the business for personal spending. So tax bills generally lag behind the revenue that you're creating. So you could find yourself in a position where a surprise tax bill can't be paid because you've taken too much money out of the business for personal purposes. So therefore, a personal budget update is strongly recommended. It's also important to have a war chest of cash to prevent against uncertain economic times or downturns. If profits are down or if you're making a loss, a strong balance sheet can see you through until profitability is restored. So now we need to look at what the balance sheet tells us. So your balance sheet, which is also known as a statement of financial position, provides a snapshot of your business's financial position at a specific point in time. So it measures the net worth of your business, which is your assets less your liabilities. It also shows if your business is solvent. If your liabilities are greater than your assets, then the business is insolvent and urgent action is needed to fix this. You can also compare different periods to determine whether the business's net worth is increasing or decreasing between years and can track the strength of the business. So the stronger your balance sheet, the easier it will be for your business to survive a downturn. It also provides a basis to calculate some key ratios, such as debtor days, inventory days, and working capital. So we'll have a look at a bit of an example. So in our example, we're going to use a building company. So the first part of the balance sheet is the equity or the owner's interest in the business. So you can see here that last year the company made a profit of 71,500, but this year it's made a loss of 45,800. So total equity is 2,000, which means that if the company makes a further loss, it will be insolvent. So strategies to implement profitability need to be implemented urgently. So we'll build the balance sheet as we go to help you understand the layout. So the company has a current account or a cash account, and you'll see that it's also running an overdraft. A current account like this is a great way to build up cash reserves for tax payments and any unexpected downturn in trading results. There's some income tax receivable of 5,000, which means that too much tax has been paid during the year, so there's a drain on cash flow. So the opposite can also happen where there's a surprise tax liability when the financial statements are done, which can put pressure on cash flow. So having a regular update of your tax position throughout the year helps ensure you don't pay too much or too little tax.
It's good, and I think an important point there, Steve, is particularly relevant at the moment where tax can fluctuate a lot. Someone's purchased an asset using and taking advantage of the instant asset write-off as well.
Yeah, definitely. So moving on, so we can see stock on hand has increased by 33,000, which is a further drain on cash flow. So holding too much in stock can put pressure on a business, as that stock first has to be sold and then the funds collected from debtors. On the flip side, work in progress has reduced by 47,500, which is good news, as the higher the amount tied up in unfinished work, the longer your cash is tied up. So in this example, work in progress is the value of wages paid on jobs that cannot yet be invoiced to customers. So the shareholder advance account or shareholder loan account is showing an asset of 66,500. So in other words, the shareholders owe almost 66,500 to the company. So this isn't good, because if the company fails, a liquidator or receiver can demand this money from the shareholders, and they won't have the protection of limited liability and will be personally liable. We can also see that the balance owed has increased by 32.5 this year, which indicates the shareholders are taking more cash out of the business than they're entitled to. So accounts receivable or debtors have reduced to 82,000, which has freed up a bit of cash compared to last year. And by referring to the trading account, we can calculate that it is taking 48 days to collect debtors. So if payment terms are 7 days, there's a significant amount of cash tied up here. So we can see there's very little value tied up in fixed or non-current assets, and this could be a signal of eroding value, as fixed assets have dropped by 23,000. In other words, some fixed assets could be in need of replacement, so there could be a future drain on cash reserves when those assets need replacing. So although the total reduction in total assets this year is only 15,500, so that's been the reduction from the 297 to the 282, we need to remember that one of the assets that has increased is the debt owed by the shareholders to the company. So the true asset reduction, excluding the shareholder loan accounts, is in fact 47,900, which is of major concern. So those are our assets. Next, look at our liabilities. So we can see that the Visa account has increased dramatically, which could be a symptom of poor cash flow. So credit card accounts need to be cleared in full each month to avoid high interest costs. If you're unable to pay your credit cards each month, it's important you talk to us about how to restructure your finances to avoid high interest costs. The bank overdraft has also increased from 36 to 38, and we need to understand what the overdraft limit is and how close the company is running to this limit throughout the month. Often the most difficult time of the month for cash is not the last day of the month. So, for example, it might be the day wages or payroll taxes are paid. We need to make sure there is a buffer of cash in the overdraft. A useful measure here is to see if the overdraft is reduced to zero at any time during the month. So if the overdraft for this company never goes below 20,000, then that 20,000 needs to be considered core debt and should be refinanced to a business loan to reduce interest costs. So GST is what we refer to as lumpy expenditure, as it's not generally payable every month, would normally be paid quarterly on your base. So a good strategy to preserve cash flow is to put aside a set amount each month for GST and other taxes as well. So already talked about using the bank current account for this purpose. If you talk to us, we can help you work out how much you should be setting aside each month for tax payments so that you always have sufficient funds available. Note here that last year the tax payable was 15,700, and if you remember this year there's a tax refund owing of $5,000. So by having regular updates of your tax position, large fluctuations in tax payable can be avoided, which then reduces cash strain and also stress levels. So a quick note here, there's a loan for a phone system. So asset finance interest rates are often much higher than bank finance. So be careful about accepting finance deals on things like phone systems, vehicles, or other equipment needed in your business. Perhaps the biggest indication of cash strain in this business is that trade and other payables have increased from 72 to 111,000. If we refer to the trading accounts cost of sales, we can calculate that it is taking 74 days to pay suppliers on average, whereas last year it was taking 47 days. So not having sufficient cash to pay suppliers each month is incredibly stressful as well as risky, and we'll look at how to calculate this soon. So we can see here that the company refinanced its loan 70 to loan 71. So in the current climate, refinancing such as this may result in reduced interest costs, but we also just need to be mindful of the legal and the loan application costs that might go with it. So with net assets of only 2,000, the company has no ability to borrow any further funds or fail the second test of insolvency, which is to always have assets greater than liabilities. We'll go into this in more detail shortly. So with the reduction in net assets of over 45,000, we need to be thinking about how we can bolster this balance sheet and reduce the risk. So we'll have a look at some specific strategies that we can adopt. So in the current climate, many businesses may have invested in their balance sheets to help mitigate supply chain issues. So what's important is to focus on what you can control and adopt practical and proven strategies to bolster your balance sheet. So there are 4 areas of focus for building balance sheet strength. So we can focus on increasing profitability, which is incredibly important in the current climate. Next is focus on improving cash flow, and there are a number of ways to do this, which we'll run through shortly. Thirdly, to focus on solvency, so that is whether your business can pay its debts as they fall due and whether assets are greater than liabilities. So having real-time up-to-date information is very important to determine solvency. And lastly, focus on your shareholder loan accounts, as these measure whether you're taking more funds from the business than are owed to you as shareholders. So having a dividend and drawing policy is essential to ensure you don't end up with an overdrawn loan account, as liquidators can chase you personally for the balance owed and also create some tax issues with Division 7A. So revising your personal budget is an important action if you haven't done so recently. All right, so our first strategy is to build profitability. So as Alistair discussed in his recent Building Enterprise Value webinar, the best way to increase your profit is to choose 1 or 2 of the 7 ways to grow your business. So to increase customer retention, build a plan to delight your clients. So under promise and over deliver to them so they refer more customers to you and don't defect to your competition. To generate more leads, focus on your marketing, especially via referrals, testimonials and social media, and these are all relatively cost-effective strategies. To convert more prospects into customers, look at strategies that will increase your proposal or quote acceptance rate. So perhaps some sales training could be in order. To increase your transaction value, implement strategies to encourage customers to spend more with you every time they buy. Perhaps offer options to upsell, picking up on that very well-known concept of offering fries with that. The other really important thing to do at the moment is to be reviewing and increasing your prices regularly to pass on increased supply chain costs to your customers in order to maintain your GP. To increase your transaction frequency, look for ways to encourage your customers to buy more from you more often. So, for example, offering loyalty benefits, a reminder service, or simply staying in contact with your customers more so you're always front of mind. To reduce your variable costs, identify strategies to eliminate wastage and rework. Also consider negotiating better prices with your suppliers if you can. And finally, to reduce overheads or fixed costs, review these at least annually to ensure you're still getting the best deal and that they're still required. So, for example, if more of your team are working from home, could you downsize your office space to reduce rent? Or could you get a better deal on your utilities by changing service providers? It's important to be careful that you're cutting the fat and not the muscle. Some overheads could be seen as investments, like, for example, investing more in your account to help grow your business. So we have dozens of practical strategies we can help you with in each of these 7 areas and can help you identify the most appropriate strategies for you. So the second area of focus to bolster your balance sheet after improving your profitability is to improve your cash flow. So the cash conversion cycle, which is also known as your working capital timeline, shows how long it takes to receive payment from your customers after buying stock from your suppliers. Or in other words, how long your cash is tied up in inventory and accounts receivable. So again, we'll have a look at an example to illustrate. So we buy stock from our suppliers on day 0. We then pay for that stock 35 days later. It takes on average 65 days to sell the stock to customers, meaning our average stock holding is 65 days. It then takes an average of 110 days to receive payment from our customers, so our average receivables is 45 days. To calculate our cash conversion cycle, we add our average stock holding and receivable days together, then take away the average payable days. And this gives us a cash conversion cycle of 75 days. So do you know what your cash conversion cycle is? You might be quite surprised. So ultimately, cash is king, and you want your cash conversion cycle to be as short as possible. So the more cash you have in your business, the stronger it will be, as it can weather downturns more easily. And technically, if you increase cash by collecting debtors, your net assets don't improve as your debtors go down and your cash goes up. However, the higher your debtors are, the more risk there is of non-payment. Also, the quicker you can convert your debtors and inventory into cash, the stronger your business will be. If you can negotiate better terms for payment of suppliers, you can preserve your cash flow for longer. However, care is needed here, though, as in the current economic climate, it's critical to maintain good relationships with suppliers. So what's important here is to come to an agreement with them. So, for example, they might agree that you only pay when you've sold the items to your customers, or perhaps early payment may help you secure suppliers and perhaps also receive a discount. So you might also look at how long it takes for your stock or work in progress to be invoiced, and obviously the quicker the better. Consider whether you need to hold so much stock or if you can issue progress invoices or reduce the number of jobs you have on the go at once. So make sure you're also keeping a close eye on how long it's taking for your debtors to pay you. So there's many things you can do to get paid faster, like updating your terms of trade, automating or repeating invoicing, or simply chasing up your slow payers with a systemised process or credit manager. And so a healthy cash conversion cycle is also required in order to pay out the profits from the business to the shareholders. So again, let's look at some examples on our building company. Okay, so we can see that inventory is taking 38 days to sell, whereas last year it was only taking 15. If we can reduce the days by 9, we can free up about 13,500 in cash. Work in progress is taking 10 days to invoice, which is much faster than it was last year at 41 days. If we implement weekly progress invoicing and reduce this by a further 5 days, we can free up another 7,500 in cash. So out of interest, if we look at last year when it was taking 41 days to invoice the work, if we reduce this by 25 days, we would have freed up 38,500 in cash. So looking at our debtor days, they've been pretty consistent between 45 and 48. If we can reduce them by 18 days, therefore meaning it only takes us 30 days to get paid, we'll free up another 31,000 in cash. If we add to the cash we could free up by reducing our inventory days, work in progress days and debtor days, we would free up 52,000 in cash, or almost 92,000 from last year. So it's taking 74 days to pay suppliers, which isn't sustainable. We need to reduce this by at least 30 days so that the company is staying current on payments owing, and this would require 45,000 in cash. So if we take the free cash we've created of the 52,000 and deduct the 45,000 extra cash needed to repay creditors, then our cash flow would improve by 7,000. So the key thing here is that life will be so much less stressful for the owner of the company, not waiting so long to be paid and being able to pay suppliers on time. And again, improving those relationships with your suppliers. So just to recap where we're at so far, our first strategy was to build profitability and the second to improve our cash flow. So moving on to the third area of focus to bolster your balance sheet, which is to maintain solvency. So as mentioned previously, there are two components of solvency, often referred to as the first and second limb. So firstly, the ability to pay debts as they fall due, which is measured by ensuring that current assets are greater than current liabilities. The second part of the test is ensuring that total assets are greater than total liabilities, not just the current ones. So looking at our example again, here we've taken the current assets and current liabilities section of the balance sheet to calculate our current ratio. So your current ratio tells you if you're able to pay your debts as they fall due. To calculate the current ratio, we divide total current assets by total current liabilities. We can see that in 2020, our current ratio, 2021 I should say, our current ratio is 1.31. So this means that there's $1.31 of current assets for every dollar of current liabilities. And last year in 2020, there was $1.55. But we need to adjust out the shareholder loan accounts because this is not a realistic current asset in that the shareholders are not going to pay this money back to us within a month or two. Now we can see there are actually only 92 cents of current assets for every dollar of current liabilities. So the company is therefore technically insolvent. To fix this in the long term, we need to go back to our first strategy and increase profitability. And for the short term, the company either needs an injection of cash from the shareholders or part of the bank overdraft needs to be converted to a term loan. So we'll talk about the shareholder loan accounts shortly, but first let's look at the second part of the solvency test, that total assets are greater than total liabilities. So our net assets, or total assets less total liabilities, appears to be positive at just over 2,000. However, if we exclude the overdrawn shareholder loan accounts, the company is actually insolvent by 64,000. So the company needs a short-term cash injection of at least 66,494, so let's call that 70,000. And so by doing this, we can eliminate the bank overdraft and the shareholder loan account becomes a liability of 3,500. So therefore, true net assets are now 2,087. Of course, the company still needs the previous strategies to increase profitability and cash flow, but at least the two limbs of the solvency test can now be satisfied. So that brings us to our fourth area of focus to bolster the balance sheet, which is managing your shareholder loan account. So we've already covered the risks associated with overdrawn shareholder loan accounts. The main risk is that if your company gets into financial difficulty and a receiver or liquidator is called in, your personal assets may be at risk as the loan is likely to be called up. So a great way to avoid any overdrawn shareholder loan accounts is to update your personal budget so that you can reduce the amount of drawings you take from your company. And so personal budgeting is a rewarding and empowering thing to do. And while we're on that topic, to set a regular weekly or monthly amount that you take from business and stick to it. Lastly, to protect you in the event the business does get into financial strife, having security for advances you've made to your company ensures that in a liquidation, you stand a higher chance of getting your money back. So to recap, we've obviously covered a huge amount of detail here and some of it's quite technical, but the main message from today is that your balance sheet is fundamental in assessing your business strength. So there are so many things you can do to bolster your balance sheet, including the strategies to build profitability, improve cash flow, maintain solvency, and manage your shareholder loan account. So the aim is to help you take what you've learnt today and implement some positive change in your business. So what are the next steps from here? So doing nothing is not an option, because doing what you've always done is unlikely to give you the same results as you've had in the past. Remember to put the oxygen mask on yourself first. Planning for sustainable improvement starts with you and the leaders in your business. Got to make a plan for the steps you'll need to bolster your balance sheet. Focus on what you can do as opposed to worrying about what is out of your control. And of course, we are here for you and want to help. So how we can help? So obviously the information in this webinar is just general in nature and no substitute for some specific tailored advice specific to your circumstances. And there are several ways that we can help you more specifically beyond today's webinar. So to help you implement strategies to improve your cash flow, we offer a cash flow management coaching service. Or if you'd like more help to understand your numbers, we also offer financial awareness coaching. If you're not quite ready to commit to a paid service, you can send us your figures and we will complete a free balance sheet health check. And we could also catch up for a complimentary discovery call to see how we can help you achieve your goals. So moving on, just to see if we've had some questions come through in the chat there, Brent.
Good summary, Steve. Certainly a lot to think about from what you've gone over there. Yeah, a couple of questions have come through. So I'll wheel them out now and Steve can run through them. So the first one we've got, and you've sort of alluded to it earlier on, but what is the difference between a current and non-current asset or liability in your balance sheet?
Yeah, so current is anything that's going to happen within 12 months. So then non-current is anything that will happen from 12 months onwards. So that sort of just dictates where it sits in the balance sheet and sort of frames the focus for the 12 months going forward.
Yeah, that's good. Okay. Now on our balance sheet, what is the most important KPIs that we should be tracking when it comes to knowing how healthy our balance sheet is?
Yeah, I suppose the most important KPI is really the cash flow conversion cycle, or the working capital timeline that we sort of touched on. Another good measure is return on capital invested, so your net profit as a percentage of working capital. So yeah, really keeping an eye on those two things. Two very key performance indicators. Yeah,
so really a measure of how efficiently your working capital is working for you.
Yeah, that's right. How efficient your working capital is in fact working.
No, that's good. So as far as the actual is improving your cash flow, you've talked about improving profitability and improving cash flow, giving us some tips on improving cash flow. Someone is asking, like what's the difference between profit and cash flow, and how do we improve cash flow?
Yeah, so we touched on the levers for improving profit before. The levers for cash flow, the 7 levers there. So you've got volume, pricing, your GP or your COGS, expenses, debtor days, payables, and your stock days. So they're the things that implement and sort of factor into your cash flow and what you can do to influence those. And as you know, I suppose that's really what we're focusing on today is, you know, the cash flow conversion cycle and how that links through to the balance sheet.
Yeah, that's good. All right, that wraps up most of the questions for us now. Do you want to, got any parting thoughts for us, Steve? Or?
Yeah, I do have a little parting thought here. So just a bit of a quote here. So business is many things, the least of which is the balance sheet. It's fluid, ever-changing, living thing, sometimes building to great peaks and sometimes falling to crumbled leaps. So I suppose from here, need to make a simple plan today. So to commit to at least 3 actions you'll take as a result of today's webinar. So write them down, give each of them an owner and a completion date within your business. And of course, remember, if you need our support, we're here for you to help at any time. So that just about wraps it up for today. Thanks everybody for attending. We appreciate the times very valuable, and please, yeah, stick around to join us for the next session. Keep an eye out on all of our socials and marketing communications. And yeah, we hope to see you again soon, and hope you got a lot out of today's session.